Importance of inventory valuation. Inventory affects both the balance sheet as an asset and the income statement through cost of goods sold, COGS. Accurate inventory valuation is necessary for correct profit measurement, tax reporting, and compliance inventory management and control decision-making regarding pricing and purchasing. Inventory cost components. Inventory cost includes all expenditures to bring inventory to its present location and condition, including purchase price, import duties and taxes, non-refundable, freight and handling costs, storage costs, if necessary for production, conversion costs for manufactured goods. Inventory costing methods. 3.1 First in, first out, FIFO, assumes the earliest goods purchased are sold first. Ending inventory consists of the most recent purchases. In periods of rising prices, FIFO results in lower COGS and higher ending inventory value. 3.2 Last in, first out, LIFO, assumes the latest goods purchased are sold first. Ending inventory consists of the oldest purchases. In periods of rising prices, LIFO results in higher COGS and lower ending inventory value. Note, LIFO is allowed under US GAAP, but prohibited under IFRS. 3.3 Weighted average cost calculates an average cost per unit of inventory. Formula: average cost of beginning inventory, cost of purchases units in beginning inventory, units purchased, hate text, average cost. Half-rack R text, cost R text, units of beginning inventory, plus R text, cost of purchases, R text, units in beginning inventory, plus HOM text, units purchased. COGS and ending inventory are valued at this average cost. 3.4 Specific identification tracks the actual cost of each specific item suitable for unique high-value items like cars or jewelry, not practical for large volumes of similar items. Effects of inventory costing on financial statements. Different costing methods affect reported net income, taxes, and financial ratios. FIFO generally shows higher net income and assets during inflation. LIFO lowers taxable income but reduces reported profits. Weighted average smooths out price fluctuations. Lower of cost or market LCM rule. Inventory must be reported at the lower of its historical cost or market value, replacement cost. This conservative approach ensures inventory is not overstated. Inventory management and controls. Periodic versus perpetual inventory systems. Importance of physical inventory counts to verify records. Use of technology. Barcode scanners. Inventory software. Preventing theft, obsolescence, and spoilage through controls. Practical example. A company has the following inventory activity during the month. Date, units purchased, cost per unit, Naira, and total cost, Naira. 1. Beginning inventory, 155,002. Purchase 1, 255, 11,003. Purchase 2, 150, 69,000. Total units available equals 450. Assume 300 units sold during the period. Using FIFO, COGS equals 100 times 50 plus 200 times 55 equals 5,000 Naira plus 11,000 Naira equals 16,000 Naira. Ending inventory equals 150 times 60 equals 9,000 Naira. Using weighted average cost equals 5,000 Naira plus 11,000 Naira plus 9,000 Naira, 450, 25,000 Naira, 450 approximately equals 55.56 Nigerian Naira. Cost of goods sold equals 300 times 55.56 Nigerian Naira equals 16,668 Nigerian Naira. Ending inventory equals 150 times 55.56 equals 8,334 Naira. Summary. Inventory valuation methods significantly impact financial reporting and business decisions. Understanding the strengths and limitations of each method enables accurate inventory accounting and compliance with accounting standards.